Hello everyone, welcome to Commerce Guide. This is Pranali. In today's video, we'll be discussing how to record the journal entries in the books of accounts. So, for recording these transactions, you need to have a clear idea about the types of accounts and the rules of accounting. I've made a separate video on the rules of accounting. You can watch that first for a better understanding. I've given the link below in the description box. You can watch it. So let's start with today's class. We'll see what is the journal first. So journal is a book in which all the transactions of a business are recorded. Now it can be any type of business such as an electric company, a software company, a pharmaceutical company, banks. Okay, so they need to record their daily transactions in a book which is known as what journal. Okay, so these journal entries follow the double entry bookkeeping. Okay, so these journal entries follow double entry bookkeeping. That is, every transaction is recorded in at least two accounts. Okay, so while one is debited and another is credited. Okay, so we'll see the format of a journal. Here it has five columns. First is date column in which date is mentioned. Second is particulars column where the name of the account to be debited to the name of the account to be credited. Then third column is LF column. So what is LF here? LF is ledger folio. Okay, so ledger folio is a page number of an account in the ledger. That is, it's the number at which your transaction is recorded in the journal. Okay, so from that number, you can easily come to know where your particular transaction is recorded. Okay, it is like a evidence. However, in general, we don't use this, but in practical, when companies prepare the accounts, they mention it as it reduces time in recording and rechecking. Okay, then next column, fourth column is debit amount, fifth column is credit amount. Okay, so before proceeding further, let me give you a quick recap of the rules of accounting. So our first account is what? Real account. Real account rule is debit what comes into the business, credit what goes out of the business. Second is personal account, debit the receiver, credit the giver. Third is nominal account, that is debit all the expenses and losses, credit all the incomes and gains. So now we'll start with the journal entries. Okay, how to record the journal entries. So first entry here is cash brought in by the proprietor as capital rupees 30,000. Okay, so let me give you an example first. Okay, suppose there is a person wants to start a business. Okay, so suppose he is starting a medical shop. Okay, so this person who is starting the business, he is known as proprietor. Okay, proprietor, or it can be a owner of the business. Okay, so to start the business, suppose he is in requirement of rupees 10 lakhs. Okay, so he is investing in this medical shop of rupees 10 lakhs. So this 10 lakh is known as what? Capital. Okay, so the money invested by the proprietor in the business is known as what? Capital. Okay, so the first entry is here cash brought in by the proprietor as capital. Okay, so see every transaction has two accounts. Okay, every transaction is affected twice. So we'll see cash brought in by the proprietor. So cash is coming in here. So here cash account will be affected. Next is what? Capital account because capital is going out of the business. We're investing in other business. So capital account goes out. So capital account is been affected here. Okay, so see here cash account debit because cash is coming in the business. What our real account rule says cash what comes in. So cash account debit to proprietor's capital account, that is credit what goes out of the business. So cash account to proprietor's capital account 30,000. Okay, so we'll see the second entry goods purchased from Madan Lal rupees 5,000. So the two accounts which gets affected here are they are purchasing the goods. So here purchase account gets affected, purchase accounts or goods account. Okay, they are taking it from Madan Lal. So Madan Lal is a person here. So person comes in. personal account. Okay, so two accounts are purchase account and Madan Lal's account. Okay, so here goods are being purchased. So debit what comes in? So purchase account debit. Now here the personal account rule is applied. That is, now Madan Lal is the giver of the goods because they are purchasing the goods from Madan Lal. So Madan Lal is the giver. So credit is what? Madan Lal. Purchase account debit to Madan Lal rupees 5,000. Okay, so next we'll go to third entry, that is goods sold on credit to Devraj. Okay, they are selling the goods to Devraj. So Devraj is what? He is the receiver of the goods. So receiver is who? He is being debited. Debit the receiver. So Devraj account debit to sales account because they are selling the goods. Okay, that is credit what goes out. So two accounts which gets affected here are sales account and Devraj account. That is Devraj account debit to sales account because Devraj is the receiver and to sales account because they're selling the goods rupees 1600. Fine. So next we'll go to fourth entry, that is rent paid for shop rupees 3000. So here two entries which get affected are, first is rent. Now what is rent here? Rent is an expense. Rent is an expense of the company because they're paying the rent. So rent. Now they're paying this rent in the form of cash of rupees 3000. So cash account gets affected here. Okay. Now see, rent or the expense comes in the nominal account. Now what nominal account rule says that debit all the expenses and losses. Okay. So what we're doing is that we are debiting the rent to cash account because cash is going out from the business as they're paying the rent. So cash account will be credited for rupees 3000. Okay, so fifth entry is cash withdrawn from bank for office use. Now here they are withdrawing the cash, means what? Cash is coming in. So cash account from bank. Now who is bank here? Bank is a artificial person. Okay, now say artificial persons are banks, or we can say they are the artificial persons are the banks, companies, okay, and the charitable institutions and all. Okay, so bank is a artificial person here. Now from bank, so bank account gets affected. Now bank is the giver of the good, so bank account is credited and cash has been received, so it has been debited. Cash account debit to bank account rupees 5000. Fine. So next entry is what? Cash drawn by proprietor from business for personal use rupees 3000. Now what is been mentioned here is that cash is drawn by the proprietor. Again it has been withdrawn, but for personal use this time. And the cash which has been withdrawn for personal use is known as what? Drawings. For personal use it is known as what? Drawings. So now drawings account is being debited. Okay, because they are receiving the money in the form of drawings here. Now to cash account, because cash is going out from the business. Okay, cash is going out from the business, so cash account is been credited. So drawings account to cash account rupees 3000. So this is the difference between what these two entries. For office use entry is different, for personal use entry is different. Okay, so that's it for today's session. Hope you liked this video. Don't forget to like, share and subscribe to my channel. Thank you.